Welcome to this Killick Explains video, and welcome to the first video in a 4-part series on fund basics. And in this video I'm going to ask and answer a fairly obvious question: what is a fund? For those people who are not sure, or anyone wanting a refresher. So essentially there are two ways you can invest in something like shares, and I'm not suggesting that funds only hold shares, but those two ways are directly. Now, I don't recommend single stock investing ever, so directly means through some kind of portfolio, if you like, that's been set up either by you or on your behalf, or what I want to look at is via a fund, and that is handing your money over to a fund manager of some sort. So what exactly are you handing your money over to? Well, there are basically three types of fund in the UK, I would argue. A unit trust, also known as a mutual in the US, or it's the closest thing to it if you like. An investment trust is number 2, and an exchange traded fund is number 3. And unsurprisingly, having covered off what a fund is in this video, I'll be going back in videos 2, 3 and 4 to the other topics. So what are the basic principles? The basic principles are this: if you give your money to a fund manager, this is not setting up your own portfolio, this is handing your money over, you'll be getting in return either units in a unit trust, and they're very common in the UK, or shares if you're buying an investment trust. It's called a trust, it's actually a company listed on the stock exchange. Now, why would you do this? Well, you're basically handing your money over to a fund manager who will aim to give you income, potentially, growth, depending on the style of the fund, or a bit of both. And you'll know which because the fund should have a mandate. It'll have a strap line and say, well, we're a UK income fund, but there'll be a mandate which sort of dictates what the fund manager can and can't do on behalf of investors. Now, why do people buy funds then? Given you've got a choice of direct investment or this vehicle called a fund, I would say there are several reasons. Expertise is one. Now, some people challenge that, but fund managers do claim to be experts in particular parts of the market. They claim to be experienced and so on. There's access. It may be difficult for the average investor to buy Indian shares, for argument's sake. A fund may be able to get them on your behalf. There's cost. The fact that loads of investors are investing in a fund gives the fund manager economies of scale. These are not necessarily cheap, but they are cost effective is the argument. They're straightforward to understand in most cases, although not all cases, be careful, and they do like to advertise. So a sort of benefit is you've probably heard of a unit trust because they have adverts all over the tube, on the sides of buses and so on. So what are the downsides? Why do people sometimes choose to go with, say, a portfolio of 30 stocks, for argument's sake, rather than giving the same money to a fund manager? Now, this is debatable, but first of all, the strategy may not be fully obvious, and you can get something called style drift. So that's where the fund markets itself as being emerging market growth, which has got a woolly title, if you like. So it's not necessarily obvious what's under the bonnet, what types of sectors, what types of geographies, without a bit of digging. And style drift is where a fund manager literally drifts away from the original mandate in search of alpha, additional returns, and that can be dangerous. They're not always cheap. I mean, yes, economies of scale apply if lots of investors buy the same thing, but there are quite a few different charges to watch out for. Initial charges, which might be waived, management fees as you're in there, exit fees, platform fees and so on. Things can also go wrong structurally. Unit trusts, I'll come back to this, can suffer gating. They can suffer lots of investors trying to exit at once, and that can create liquidity issues. More about that coming up in a future video. Okay, so what we need to do in videos 2, 3 and 4 is to break down a bit more on unit trusts, a bit more on investment trusts, and a bit more on exchange traded funds. So keep an eye out for those. In the meantime, if you'd like to know more about any of the terms I've been mentioning, quite a bit of jargon in the funds world, then do access our video library, killick.com/learn. For a copy of my guide, it's this blue one here, How to Invest in Equities, email editor@killick.com. And if you'd like to read about funds once a quarter in a more commercial context, then Confident, our quarterly magazine that I edit, is also editor@killick.com.